Hello, everybody, and welcome back to the M3 market update. This is the weekly version. I did a deep dive on Sunday. I'd love for you guys to check that out. But in general, hoping that the M3 market update becomes your one-stop shop or the only exit you take to kind of understand and talk about housing or to hear what's going on in housing. There's a lot, and commercial real estate. There's a lot going on out there. There's a lot of mixed messages. And as a rule follower, I really hate mixed messages. So, please come by, check me out every week. I'll be posting this on Twitter, etc. So, welcome back. There's a lot going on. I wanted to kind of pick up this week before we get into the specific updates, which will be kind of on listings for sale, rent prices, and Airbnb prices, and a whole bunch of other different information. For those of you who are unfamiliar with me, I wrote an article in January called Debunking the Inventory Myth that really set out some themes about what kind of housing inventory we can see, what we will be seeing come onto the market. I'm calling it the shadow inventory because regardless of the fact of whether it's listed for sale right now, it will be listed in the coming months. And so this show, as well as all the work that I do, is all about trying to track these themes, see where they're going. And by the way, guys, if I'm wrong, I'm happy to be wrong. But that's the point of this, to figure out where housing is going. I very much don't want anyone to be caught out unaware or make a decision that's going to haunt them for some time, similar to the way many folks were caught unaware during the great financial crisis. So I'm not saying that this is going to be exactly the same. In fact, I argue this is going to be very different, but it's going to be just as disruptive, if not more so. So hope you join me each week to kind of hear what's going on so that you can stay in the know. Okay, so a theme that I did a Twitter space on Thursday. We didn't get very far in a lot of what I was trying to talk about, which was with these bank failures, there are two really significant groups of assets out there being sold, and that sale is being those sales, I should say, of those assets, around $27 billion for Signature, $87 billion for SVB. That's being handled by BlackRock, and I have quite a bit of experience with BlackRock in my career, having been our company, they were brought in to help us with some of our distressed asset sales. And so I make some jokes in my Substack about how I used to sleep with my asset sale schedule because right next to me, because the CEO, the CFO, everyone wanted to understand where we were with asset sales. And just as why did they want to understand that? They wanted to know where we were with liquidity, mainly. I mean, as I've kind of said to you guys before, one of my jobs was to look at our tangible net worth every single day. So ton going on back then. But these asset sales are important to me because I think, as we know, price is set at the margin. I think as these sales kind of go forward, we're going to get a better sense of what is the true asset value of these multifamily properties, these mortgages, as well as this commercial real estate. So it's going to be very important to understand how much those assets are sold for and who takes them, quite honestly. The only thing that we've heard so far, though, is about one under $300 million of some, it was a loan portfolio at 2.5% to 3%. Coupon, which would be a decent asset to sell right now. So, and they got 85 to 90 cents on the dollar. I have not seen any other reporting on what's happening. Now, if you're a part of one of these companies that's participating, you know all of this, and I'm completely unaware at the moment, and I'm making some assumptions. But the fact that we haven't heard about these asset sales and the pricing that is actually being accepted or not at all accepted, and they're going nowhere, I believe we haven't heard because it's probably not as great as everybody wants it to be. And I think that as soon as the market sort of sniffs out what I'm calling this price discovery from this exercise, I believe that kind of the the soft landing, no landing, everybody is going to have to just accept that's not going to happen. And, I think a lot of folks, it's very funny. My video last week, I didn't talk at all about the Fed. And some of you may have wondered, wait, why isn't she talking about the Fed? Isn't that the most important thing to be talking about? I don't believe so. I've talked to you guys about, I believe the Fed is about expectation management. I post some references in the show notes. Please check those references out. It's very important to understand that the Fed keeps us backward looking. They're not, I honestly don't believe they have the ability to truly stop what's about to happen. I think the train has left the station. And whatever they do at this point, I don't know that it matters. They could do some things to make it worse, but I don't think that it's ultimately going to change the outcome of, I think, what's ahead for us as well as globally. And I'm not trying to be doomy, gloomy, none of those things at all. What I'm trying to do here is give us a little dose of reality about where we are, hoping for the best, but being prepared for the worst. And we'll probably land somewhere in between, guys. I have no vested interest in a housing market crash per se. I do have interest in people being able to afford their homes. That is important to me because I feel like shelter is kind of important. And so I don't think that housing should necessarily be a casino. I do believe that, people should be able to buy an affordable home. I also believe that investors should be able to participate if they can help make that happen. So, I'm kind of one of those people in the middle. I'm not rooting for a crash, but I am rooting for affordability. And one thing that I often say on Twitter is that price will meet affordability one way or the other. Either the markets will decide or the government. And I spend a lot of time talking about kind of that debate in my Substack this week. Really would recommend you guys checking that out. I pose a question that I think it's important, and all of you are probably, on a very wide spectrum of this debate. Some of you may say, Melody, what? Of course, there's no difference. Sorry, I'm ahead of myself as usual. But I kind of talk about the difference between public and private. And is there a real difference, especially in housing? Because since the 30s, guys, the 30s, okay, government has been heavily involved in housing. And that hasn't changed. And since the GFC, it's even more. And then with COVID, this is a government market that you're participating in. There is no other way for it because all the private lending sort of went away. You do have what we call non-QM, but it's a very small portion of the market with very specific players, some that will gain notoriety as we talk about them in the future, because there's going to be some issues there on these, I don't call them, they are the DSCR or debt service coverage ratio loans. So we'll be talking a lot about non-QM, but just know that was such a small portion of the industry. Everything else is pretty government backed, meaning that is sold to the agencies or to Ginnie Mae for securitization. So understand that this marketplace in housing probably doesn't operate the way that you think it does. And I think that, during the GFC, before then, if you think about It's a Wonderful Life, we all saw the banks as these big bad boogeyman, but that's not how this operates today. So would encourage you to listen to my weekend deep dive on what we call loss mitigation, and that's how to keep borrowers from going into default, because I go into the way that government has participated. Now, you're thinking, what the heck does this have to do with BlackRock? Well, very interesting article that I posted on Twitter last week about how BlackRock has kind of become the de facto asset manager for the government and how they've positioned themselves for that. So want you guys to, check that article out. But all this is to say, so you've got BlackRock coming in to handle these sales. They're kind of doing it under a rock, behind a rock. this is very similar to the way that it happened last time as well. You have a group of players. They're always the same players, by the way, that all, sign their little NDAs and participate. And they all know what price, like they are getting it right now. And I guarantee you, many of these assets will not be going for 85 cents to 90 cents on the dollar. That's just not going to happen. So, and once that happens, then the dominoes can start to fall. So, a lot going on. Would really, 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 really encourage you guys to read the Substack this week. I posed some very interesting questions, one of which is, would you be making the same decisions today about either purchasing a home or purchasing, let's say, a community of build to rent, if you knew for a fact that the government would be heavily involved in the future with perhaps purchasing some of the homes right next to you, or purchasing its own built to rent subdivision? And this may sound very, I don't know, Orwellian or something, just very dystopian. But guys, I really think that this is where we are. And, a lot of people still don't even understand the scope of the problem because they haven't seen it as I have on the road. And again, guys, whatever city you're in, contact me. I can give you some addresses. Go check them out. It's very unlikely you're not close to one of these sites. Now, there are some pockets in the country where this is not happening 100%, but it's happening in a lot of areas. And so I am all about creating a citizen army so that other people can be aware of what's going on. So contact me. If you don't believe me, I can point you to some of these big multifamily properties, some of these empty new build sites, and you can go take a look for yourself. Because at this point in time, guys, everyone is screaming data, some piece of data or information. All of it is contradictory, and half of it isn't even being conducted in what we would consider, sound data practices, due to the fact that we have reduced survey participation and then revisions. There are so many people that can talk to you about this way more than me. I'm not going to waste our time, but you have to know where the data is coming from. You have to understand its limitations, and you can't look at one data metric. So, big thing of sort of my post and my video this week is be looking for the results of these asset sales from BlackRock. Be looking for assets going up for sale, maybe from Chase after their recent acquisition. So these things are going to be important, and it's interesting. Typically what'll happen is we'll hear about them in isolation. And sometimes we won't even know that it was a distressed asset sale, but we'll hear about it in isolation with like maybe one news article about one asset purchase. And that way it seems like, oh, that's a one-off. That's not something that's going on. It's not pervasive. But in reality, guys, you have to start amassing these things together because they're painting the picture. So, welcome back. Thank you for viewing. We'll kind of jump into the updates right away this week. The first thing that I want to say is, okay, Las Vegas was not an outlier. It did not have a huge increase in sales this week. It had a kind of net loss of 200 listings, but of the 1.7 thousand that were added the week prior, that's nothing. And I'm definitely seeing in some of these Sunbelt states, they got started early with kind of the spring buying season, and I'm seeing a lot of movement in the inventory. And I would say Las Vegas is one of those. Phoenix is one of those. California is just all on the move. But what's interesting in California, Sacramento particularly, is I'm starting to see inventory build, meaning net week over week over week. I'm getting incremental build, incremental build, incremental build. So what I kind of posited last week is that there is certain very specific demand out there that is being met by all of the builders through concessions, throwing everything at the wall they can to sell those homes and to keep that top line price. However, once that little bit of demand goes away, at the same time, builders are going to start listing those properties because they're seeing this action. Everybody's always late to the party, guys. Always late. So, they're going to essentially be throwing everything there, and they're not going to realize that that small amount of demand is gone. And the only way that demand is going to come back, it's not with lower rates, although that'll help. Don't get me wrong, but I think that we have sort of accepted where rates are. It's going to be those home prices. And again, this, depending on the amount of government involvement, this picture can be very muddy. In the Substack, I talk about one program in particular, that's the Homeowner Assistance Funds, or HAF, as I know it, where almost $10 billion went out to the states to use for just miscellaneous expenses to give to borrowers in case they were impacted by a COVID hardship. And so this is a really big deal. And at the moment, the average amount of sort of payout of those funds is only about 25%. There's only a handful that have dipped in over 50%. Why? Because they haven't had to. The federal programs are keeping everybody okay for the most part, except for your huge outliers. Think about it. If you had 12 months you were behind 12 months, and you could just put that on the back of your loan, then you could start as if nothing had happened. Well, the problem is people are getting into distress even with those things, which should tell you they cannot afford those homes, not with property insurance and taxes on the rise. So lots going on. In fact, and so next week, likely we will have some new home prices to look at from Redfin. So I'll probably do a kind of a side-by-side of those and the NAR, our National Association of Realtors, their latest results. So that'll be, look for those always in the middle of the month. So there's some timing to all of this. But okay, quickly, let's get into kind of the, inventory updates for this week. So top cities with the highest percent increase in listings week over week. So guys, when I say these percentages, realize this is week over week. And so in these larger areas, it's not 10 properties, it's quite a few. So keep that in mind. And again, check out my Substack because this is all listed in a very easy way to digest. Also, I have a kind of matrix that I keep behind the scenes. If you'd like to receive that via email, contact me on LinkedIn. I'll be happy to send that out to you. And when I get super good at this, which is going to be sometime, shout out to all you people that do this because it's a lot. I'll have slides. I'll have beautiful graphics. As I've kind of talked about, I have a lot going on. I'm really actually passionate about getting this information to you more than at the expense of my own embarrassment. So, okay. Top cities with largest percent increase in inventory week over week. We've got Carlsbad at about 8%, Salt Lake City at about 6%, Nashville at 5%. This is big, guys. I've kind of been waiting for Nashville to get out of its delusion. I think it's finally getting there. Denver at about 3.6%, Seattle at about 3%. Week over week listings. Now we are in the thick of this, our season, the buying and selling season, but these are still pretty significant. Okay, top cities with largest increase in inventory from the start. So I started this in January. I wanted to, I wrote that article and knew that I needed to start tracking this so that I could see how long this was going to take, what direction. And by the way, everybody thought I was a crazy person, which is, standard for me. So no worries. Okay. So top cities with largest percent increase in inventory from start. That's going to be San Ramon at almost 77%. And these properties, very high valued, all in the millions of dollars. San Francisco, 73%. San Jose, 50%. Denver, 47%. Coeur d'Alene, 41.7%. Heard from my buddy there. Sounds like they're going to be layoffs. They are preparing there for a very slow tourist season. And, this is very interesting since we saw all of those inventory increases. So again, we can't just be looking at our traditional measures. We need to be eyes wide open, looking all around, because these traditional measures are very lagging, and plus the data is just a disaster. Hoboken, almost 40%. Boston, 38%, almost 39%. Austin, 38%. These are big numbers. Austin, especially with what is going on there, there is a lot of inventory. If it's not listed, guys, one thing I've seen is, like, let's say it's one of those new build sites in Round Rock or somewhere like that. They list one of the homes and that's it. But there's, 100, 200 lots there. Now, that's not every single builder, but that's a lot of them. Plus, we've talked a lot about pocket listings, things that never made it to the MLS listing sites, private builders. So there is a ton of inventory out there that people don't want to call inventory. Just again, I posted, I think yesterday, American for Rent is selling. They're selling their rental properties. So those became existing. Those were built to rent, and now they're sold. Some of them were acquisitions, but the fact is they're becoming a net seller. Okay. So the inventory is coming. If people don't want to see it, I don't know what to say. And if I'm wrong, hey, we can all have a party or whatever, because if I'm wrong, then things are going to be a lot better for all of us. Rent. Now, rent, we see the movements in rent these first 2 weeks of the month. So got a little info here. Top cities with highest percent of average rent price decreases. Portland at negative 6%. Fort Lauderdale, Miami, I track them actually separately because I think that one of our issues is that we put together too many things. And so I definitely am trying to keep things as separate as possible. But they actually came in because of the similarity in listings at around the same, negative 5.69%. Asheville at negative 2%. Tampa at negative 1.7%. I think these are interesting. But what I find even more interesting are the cities that are in absolute denial and are not coming down as much as they should be. But I think, again, that's a matter of time. We're at an inflection point. It will be happening soon, I promise. And then top cities with highest percent decrease in rent per square foot for specific new multifamily complexes. So some of you may have read my Substack. One thing I did once I came back from the road is I just couldn't believe that I wasn't seeing higher vacancies because I saw all of these multifamily properties and they were empty. So what I decided was to choose one of these built after 21 or the newest built with 5 or more units and track specific properties. So next week I'll be sharing those, as a kind of a stat sheet of where those all are. But very interesting in some of these cities where listings are going up, occupancy is going down. Now, could this be people selling and renting? I don't know. But it's going to be interesting to track. And so we will definitely stay on top of that. Okay, so again, top cities with the highest percent decrease in rent per square foot for specific new multifamily complexes. Encinitas down 3.57%. Fort Myers down 3.56%. Asheville down 3%. Tampa down 1.8%. Boise down 1%. Okay, so these are brand new buildings. Watching these will be very, very fascinating, especially around vacancy, which, again, I'll share some of that next week. And then Airbnb this week was kind of comical. Just so you guys know, the way that I capture Airbnb prices to be consistent is I choose a date 2 weeks in the future. This week, that happens to be Memorial Day weekend, which is kind of cool. I mean, to see how this all kind of pans out, I guess I would say, because some of these increases are hysterical. Now, Again, I could be wrong. There could be somebody out there that's willing to pay this now. But what I'll do next week, which will be very different, is I'll actually go back and look at the same week again and the average prices, because I am so curious about this. But top cities with Airbnb average price increases week over week. Rosemary Beach at 58%, San Francisco up 46%, Chicago up 34%, Boston up 34%, Cape May up 32%, Phoenix up 31%. Phoenix, I'm super curious about. Okay, and then top 3 cities with Airbnb average price decreases week over week. Now, not many had these in anticipation of the Memorial Day weekend. So there were only a handful, but Huntsville was down almost 9%, Salt Lake City down 6%, Washington, D.C. down around 3%. So, this will be interesting. I think all of us are kind of curious about, Memorial Day, and how travel will look. As I kind of talked about in a previous show, a lot of people book their travel early. I have several family members that are doing big trips in May. But, based on what I know about them, it's probably their last big trip. So I think we'll all be looking to kind of understand where the consumer is on that Memorial Day weekend. So it'll be fascinating to track these prices. So lots going on. Like I said, this week, tomorrow, very excited. Airbnb earnings should come out tonight. I can't wait to see. Not that I'm expecting some kind of crash at all. I'm not. But their messaging is always pure entertainment to me. So they're coming out later today. I'll be listening to that earnings call. And then tomorrow at 1 p.m. Eastern, Amy Nixon, our Texas runner, and I will be doing a live Twitter space hosted by Coffee and a Mic. So please join in. If you can't make it, we'll definitely record that. And then let's see what else is coming this week. I do have a Bozeman new build video I need to get up. I'll be doing that shortly. But otherwise, guys, so much going on. I honestly feel we are at an inflection point. This is it. Could something happen to stop it, accelerate it? Sure. But I can feel the turn. It's definitely happening. Some places not as much. But I think this price discovery is going to, it's going to shake up the market once we hear about it. Now, again, I could be wrong. And I've been wrong before because I'm constantly sort of taken by surprise by the amount of government intervention. And so that's why I think that it's important for us to all realize how these programs impact the data. So thank you for joining. You can find me on Twitter at M3_Melody, MELODY, LinkedIn, Melody Wright, Substack, M3 Melody, and here on YouTube. Thanks again, guys. Have a great week and stay sane. I know that I am trying to. Thank you.